optical art. Okay guys, I believe that we are in an epic bubble that is about to pop in 2021. We are right on the cusp of a huge crash. I'm going to show you why. I'm going to go into detail on this chart and show you why I believe this is the case. As you also saw, I believe that that Bitcoin is also possibly hinting at a stock market correction. I'm going to cover this chart first, then we're going to go back and I'm going to break down this chart for you. So before we get into this chart, if you are interested, these are my charts you can access on my website. This is the H1 chart. Your current resistance right now at the time of recording this video, 62,888. Your current support is 60,892. The C1 chart, your current resistance is 62,333, and your support is 61,082. I put out a video a couple days ago. It was a more comprehensive video showing you support and resistance levels, where to play them. If you want to watch that video, I'll put that up now. Do check that out. Those targets I gave you are still valid. But let's go ahead and cover this, why I believe that Bitcoin is hinting at a possible stock market correction. So let's zoom in. I have this zoomed out a little bit. All of these lines right here match. This is June 27th, 2019. This is June 26th, 2019. But let me zoom into this section right here. I'll try to get these lines to match up as much as I can. Let's see here. All right. So what I want to point out first, if we zoom in, so above is the S&P right here, and below is Bitcoin. So if you'll notice, let me zoom out just a little bit here. So if right here you can see on the S&P, notice that price is pushing up, right? From right here, it was the 14th of April 2021. The price of the S&P kept pushing up to this point. But notice Bitcoin was getting lower and lower and lower to this point. So you had some divergence with the S&P and with Bitcoin. What happened? The S&P was pushing up. Bitcoin was coming down, and Bitcoin had a drop. The stock market, the S&P had a small drop as well. And you can see the same thing is playing out. You got some divergence over here. You've got the S&P. Well, you can clearly see the S&P is pushing up, right up to our resistance. But as you can see, Bitcoin has started to come down. More divergence, hinting at a possible correction. So I'm expecting something like this, right, for the S&P, the Nasdaq, the Dow Jones. I think it's hinting at a drop. These are just smaller references with these white lines here. If we zoom out and look at the bigger picture, let me move these arrows real quick. So if I zoom out and match this up, I have to zoom out just a bit. Get these lines to match best I can. I think that's close enough. Let me zoom out here. So I'd like to point out in a larger time frame, notice that the S&P up here, notice that price has been pushing up since June 25th. The 25th of June 2019, price has been pushing up, right? But notice back here in 2019, the price of Bitcoin was slowly going down. And then right after that point, what happened? Well, we had a major correction with the S&P, and we had a major correction with Bitcoin. So that played out there. I would like to point out over here, you can see the same thing is playing out. Let me zoom in just a bit to show you. So while you can see that the S&P has been pushing up, and this is currently our resistance we're at right now, you can see Bitcoin is pretty much just done a double top. While we don't have much divergence, you can see Bitcoin has gone kind of flat, as in a double top, while the price for the S&P has pushed up. So I think this is hinting, just like back there, back here. I believe the same thing is playing out happened here, and here is about to play out here. So I believe that Bitcoin is hinting to a drop. Now this is just Bitcoin alone. If I go back to this chart, I'm going to break down this chart and explain to you why I was able to predict something was going to happen when we cross this ring right here. So let me explain this. Now this is the chart I published on January 7th, 2020. This is a published chart. I can't edit the chart. I can change the title, the description, the category, but that's pretty much it. I can't change the chart. Once you publish a chart, the chart is how the chart is. January 7th, 2020. The reason I want to play this out is I want to show you that this chart matches this chart completely. And again, this is a white ring I was predicting we'd have our COVID crash. Now I'm going to break it down and show you why I expected that. So let me play this out just to show you. So we did come down, we hit my targets. Never expected us to crash this low. Notice we bottomed on this ring. This ring is very important where we bottomed. I'm going to hit play, go a little further through. And I want you to see right here, this was another ring we crossed right here, and we're going to cover this as well. Once we hit this ring across it, we dropped all the way down here, found support, resistance support. Notice this blue ring right here, this blue ring here. That is right here. You can see right here. Notice right here, resistance, support, resistance, support. And this is another ring. We're going to cover this as well. But just to show you that it matches, resistance, support, resistance, support. Again, resistance, support, and we pushed up. And we're going to play this out. Let me play this out a little bit more to current price action. And notice right here. So you can see, notice where we found support right here on this ring. That is this ring right here. That is this ring where we found support on this published chart. That's where we found support right here. And then we pushed up. This white ring here is what I'm saying. This is the marker for the next, well, for the bubble to pop. And I'm going to cover this in detail, but you can see this is the ring, and I'm calling this the everything bubble. This ring right here. This one I expect everything to come crashing down. So you say, well, how do you know these rings cause something to happen? How did you even know this would happen in the first place? Well, if you understand how I created the charts and why I was expecting it. So if you break this down, when I created this chart, and you know, it's based off of fib channels. Fib circles are based off the fib channels. Well, again, this is the Dow Jones chart. So what I noticed was, every time we cross a white ring, we have a drop down to support. Every time we cross a white ring, we have a drop down to support. So it made sense. Okay, well, when you make contact or cross this white ring, well, look what happened. We drop down to support. And if we come over here, it just made sense. That's why I created this chart, this published chart, saying, hey, when we cross this white ring, let me refresh this again so you can see. You know, price was here, and I was calling for these targets right here because I knew something was going to happen when we crossed this white ring. And something happened. We crashed all the way down to this ring, all the way down here. I never expected to crash that much. I was just expecting us to potentially, you know, bottom, you know, somewhere around here, maybe here, but never as much as we crashed. So this is explaining to you why I expected something happen at this ring. We all know what happened. We had, you know, COVID-19 happened, and that caused a crash. So let's move forward a little bit. You notice this ring right here. I'm showing tech sell-off right here. This point with this arrow is September 8th, 2020. So this was a news article that was put out. This was, and again, take note, September 8th, 2020. Right here, September 8th, 2020. Here's what happened to the stock market on Tuesday. Dow Jones Industrial dropped 632 points. And keep in mind, we dropped a lot more than that. We dropped all the way down here to 26,697 on the 21st of September. I'm just talking about September 8th, right? And look at what they said here. Tech sell-off continues. Shares of Facebook, Amazon dropped more than 4% each. Apple and Microsoft lost 6% and 5% respectively. Tesla plunged 21%. So these tech stocks were selling off when? Right when we crossed or made contact with this next white ring. Support, resistance, support, and we pushed up. So this was another ring that indicated a potential move. And look what happened here. Now it was less severe. Not every ring's going to play out the same. You know, there wasn't much going on, but you can see what happened. As soon as we crossed this ring, we got a little pump, and then we dropped down below our support. And what happened here? Let's see, January 29th. Let's go to this news article. You can see right here, this is January 29, 2021. Let's see, stock market news, live update. S&P 500 posts worst week since October. GameStop posts weekly gains of 400%. And then you can see the S&P sheds 1.9 earnings. Let's see, shares of heavily shorted stocks had become popular stock picks among Reddit editors. GameStop rocketed higher than 70% on Friday, nearly halving on Thursday. So a lot of these meme stocks started crashing. So again, that is why we had this ring right here. This was basically when we crossed this ring. This was a catalyst or marketing event when something was going to happen. And what happened? Meme stocks started crashing. So again, this is just showing how these rings actually predict moves. We did continue pushing up, and notice this is the next ring. This ring right here, I'm calling the everything bubble. This white ring right here. Now we did push above it. We've done that in the past. My point is I believe that this ring is indicating what's coming. And again, what I'm trying to point out is if just COVID caused us to crash, and again, this is just the Dow Jones, but if COVID alone caused us to crash a total of, let me move this up, it's so far down you can't even see it. So if COVID alone caused us to crash 38% with the Dow Jones, all right? And then just, let's say, just the tech sell-off, right? Tech sell-off caused us to drop a total of, what, almost 11%? And just the meme stocks dropping, that was a drop of around 4.48%. Okay, well, if just those things cause us to have these kind of drops, right? With everything that's going on right now, and I put together a collage of videos, and every video that I'm going to be showing you, I will have links to those videos in the description. But I want you to watch this video. So I'm saying this ring is the everything bubble that's about to pop, about to have an epic crash. Again, see how much is going on right now, and you will understand the importance of this ring and how bad it can get.
Zillow just announced that they were in way over their heads. They have 7,000 homes that they need to quickly sell because these properties are now being sold for less than what they acquired them for, resulting in a massive loss. These properties are going to have to be sold at a discount. Plus, there's huge costs associated with buying and selling. So the company stands to lose upwards of $500 million on the total transaction size. They also announced that they are permanently exiting the home flipping business, aka iBuyer business, and they're laying off 25% of their entire workforce.
We're at the Port of Long Beach in California. The International Longshore and Warehouse Union inviting us for a rare look at an unprecedented supply chain crisis through their eyes.
What you're seeing out there is a problem of the supply chain being stretched at its fullest point.
40% of U.S. imports come through this port and the neighboring Port of Los Angeles. Much of it stuck for weeks in a giant backup at sea. 81 massive ships currently in line waiting to unload. We were there to see one of the ships that had docked. It's going to take 10 days to offload the 6,200 containers on this ship alone. But the time it takes to get that cargo to its final destination will be determined by other potential choke points in the supply chain. The next link, trains and trucks, moving all those goods out of the port. Drivers like Josue Alvarez, who says sometimes he waits all day for a single container.
6 to 8 hours a day, waiting in line, sitting in line.
There's also a shortage of equipment for moving containers, and storage warehouses are so full, some drivers are parking them on city streets.
This is my driveway, and we're getting blocked, as you can see.
Clogging up residential neighborhoods near the ports.
After a 2-week reprieve when share trading was suspended, the truth hits home. Investors are pulling out of Evergrande. Shares in the Chinese real estate developer tanked more than 12% today in Hong Kong. Evergrande is the world's most indebted property firm and faces a series of bond defaults.
Fears for the future of Evergrande are swirling through global financial markets, cranking up anxiety on stock exchanges from Hong Kong to Frankfurt and raising the possibility of contagion. Evergrande founder Xu Jiayin's colossal borrowings have left the firm owing more than $300 billion, and it's struggling to pay that back. The latest desperate attempt to raise cash was a $2.5 billion deal to sell its property services unit to smaller rival Hobson. The deal was doomed. After the sale fell through, Evergrande's share was back in play. It soon started to slump, tumbling 12%. The failure of the deal brought Evergrande one painful step closer to defaulting. With real estate accounting for nearly 30% of Chinese GDP, Evergrande's collapse would send shockwaves through the world's second biggest economy.
Lockdowns, mass testing, disinfection. All these measures are making a comeback in northern China as the region works to stamp out a new COVID-19 outbreak. But the Delta variant is putting this zero-tolerance strategy to the test. The virus has already spread to nearly a dozen provinces. Beijing has also been hit, with several housing compounds locked down after 9 cases emerged. People in the capital have also been advised not to leave the city unless necessary.
China is trying to ease concerns sparked by a government directive urging people to stock up on food ahead of winter. An order urging authorities to ensure adequate supplies sparked online concern, and it was made worse by fresh outbreaks of COVID-19. Olivia Xiong reports.
It's a message that sparked concerned discussion online on Tuesday. The Chinese public being told by the Commerce Ministry to stock up on daily necessities to meet their daily needs and emergencies in a notice posted online on Monday night.
Over in China, Xi Jinping is struggling to keep the lights on. His hybrid economy is literally going dark. There is no power at factories, no electricity in homes. Even traffic lights and street lamps are being turned off. This energy crunch started in pockets. A handful of factories were shutting down in August. Now it's a national crisis. At least 21 provinces have been affected. That's more than half the country. Even ordinary Chinese citizens are feeling the pinch. No mobile networks, no elevators, no lights. China is halfway back to the Stone Age. How did this happen? How does a country just run out of power? Over-dependence on coal. That's how it happens. 56% of China's power comes from coal. But their stock is running out. China's biggest power companies hold 11.31 million tons of coal. It might sound like a lot, but factor in China's population and its factories. This stock could run out in 15 days. That's how dire the situation is.
Well, a lot of them are on rotation because, again, they're stuck in the Pacific Ocean, bobbing off the coast of Los Angeles. But just to put a single statistic to exactly the point that you made, before the pandemic, if you're in the book industry and you're trying to ship books overseas or ship them to the United States, you can sell them in bookstores. Well, before the pandemic, 2019, reserving a container that held 35,000 books cost about $2,500. Now it costs $25,000. So the cost of shipping books has gone up 10x. Now multiply that across the entire economy, not just the books, but the plastics and the semiconductor pieces and the Pelotons and the furniture and the clothes or some other consumer staple that you might try to find at a CVS. That's why the shelves are empty. And so important again to say, it feels like an everything shortage. It feels like you go to the store, you go shopping online, it says, sorry, this is going to be delayed. You thought you were going to get it on Tuesday. It's going to come next Wednesday. Or you want to buy the shampoo and it's not there. It feels like a shortage, but in large part, this is coming from the fact that Americans are demanding a lot more. We got our stimulus checks, wages are rising. We're trying to buy a lot more, but we're pulling it through channels that haven't grown to accommodate all of this surplus demand.
If you had told me just days ago that Tether is providing backdoor financing for the Chinese property sector, including companies like Evergrande, I would have called you crazy. But my opinion has changed rather quickly. By now, everyone knows about Tether's questionable reserves, most notably is the fact that they claim 50% of their reserves are commercial paper. This means that they actually straight up admit to you that not every Tether is backed by an actual US dollar. Instead, about 50% or 31 billion is held in something they called investment grade commercial paper. Now, if you're like me and you have no idea what commercial paper even meant, read this Investopedia article about it. It's essentially short-term debt issued by companies which investors buy up and receive interest from. Deirdre Bosa interviewed the Tether CFO in July, who literally brought his lawyer live on air, and he confirmed a couple of things in regards to this commercial paper. Take a listen.
So let's get into some of the details. Stuart just said that you guys are backed by reserves. You guys published a pie chart that showed less than 3% of that actually was US dollars. More than 50% of that is commercial paper. I know you guys have said that it's rated A2 or above. Can you give us any more details about what exactly that commercial paper is?
So we don't disclose our commercial partners, so that is quite important. We want to, given our portfolio composition in commercial papers, we believe that is quite important to respect the privacy of the banking partners that we work with. Also, you spoke about trust, and and the fact that volume is not a proxy for trust, but when an asset is not trusted and tether is trusted, when an asset is not trusted, it gets sold at any price, and yet tether holds perfectly the $1 price on all the crypto exchanges. So I believe that it's important to underline how the broader community trusts us. So I wouldn't rely on.
So there you have the CTO directly acknowledging two things. One is that the commercial paper is definitely real. He actually reveals its grade by saying it's AA rated, which gives us a clue as to the risk involved. And second, the CTO says he will not reveal the commercial paper partner or partners. Now, why would a company that supposedly invests into safe, reliable AA grade assets fail to reveal whose debt it's actually buying? Deirdre presses him for more answers in this next clip. And just listen to what happens.
That's fair, but isn't that trust a little bit fragile? You have major people, regulators such as Treasury Secretary Janet Yellen talking about the risks of stablecoin. You've got another Fed President, Rosengrund, talking about the dangers of tether. So is this not an opportunity to come on? I'm not going to ask for names, who exactly is in your reserves of commercial paper, but could you tell us a little bit more information? For example, is any commercial paper held in Chinese companies?
Stu, you want to take this one?
Yeah, absolutely. Deirdre, our portfolio contains international commercial paper. As you noted from our public disclosures, it is overwhelmingly rated A2 or better. And we think that's the key thing here. And we think that transparency with the market and how the market has spoken and decided here is what's really important and what's important for your viewers to understand.
Of course, the lawyer handles this one, and he reveals another clue. This is international commercial paper, but refuses to directly acknowledge that it's from Chinese companies.
So let's see what the fundamental problem is with leverage and where we stand with leverage at the moment. One of the US regulatory bodies, called FINRA, actually collates information from all of the brokers in the United States on how much leverage their customers have. And this is the aggregated number for the entire US, stretching back to before 2000. Notice how recently, during this post-pandemic rally, the amount of leverage has increased hugely. It's now standing at $862 billion. And also notice that the peaks in margin tend to happen just before a market peak. So here's one in 2000, which is underneath me, which was the height of the dot-com bubble. And here's another acceleration in the amount of margin debt just before the global financial crisis. So in the next graph, we'll look at the year-on-year change in that margin debt to see how it varies in relation to market movements. So this upper panel, which you can see here, is the year-on-year change in the amount of margin debt. A positive number means there's more margin debt, so the amount of margin debt is increasing as people take out more leverage, and a negative number means that the amount of margin debt is shrinking year on year. And here in the lower panel, you can see the peak to trough fall in the S&P 500. That's relative to the previous all-time high. And sometimes people call this a drawdown graph. And now you can see really clearly that acceleration in the growth of leverage came just before the dot-com bubble burst. And in the aftermath of that dot-com bubble bursting, you can see that equity markets took a huge tumble, with a peak to trough loss of around 45% and a huge amount of deleveraging taking place while equity markets fell. And then the same thing happened again during the global financial crisis, an acceleration in the amount of leverage and a very significant fall in equity markets, this time by around 50%. And this is where I agree with Michael Burry, which is that leverage is often a problem when it comes to market sell-offs. And particularly worrying is this acceleration we've seen in leverage through this pandemania bubble. If it's anything like the previous two crises, then we could be about to see a significant sell-off.
And just finally, Jeremy, to conclude, you mentioned already some of the factors that make you think that we're already seeing this bubble start to implode, as it were. What timing are we talking about now, and what level of pullback for the S&P 500? Is it months away from tens of percents of declines?
Yeah, I would think so. Nothing in investing is ever certain. The stock market is just a perfect creature of psychology. and it's very difficult to be certain of psychology, but we can measure it in many ways in the market, and it's seldom, if ever, been this high in terms of confidence. The meme stocks are just a travesty of serious investing. And we've never seen anything to equal that. My own stock, QuantumScape, which I bought 8 years ago, when that came public through a SPAC, it quickly rose from 10 to 130. At 130, it's a brilliant company, but it's a research company, 4 years away from having a saleable product there. And it was selling for more than the price of GM at 130. There was nothing like that in 1929, nothing that extreme, nothing like that in 2000. They were hundreds of millions, not tens of billions, which are the crazy specs this time. Not to mention all the Bitcoins of the world, which are a couple of $1 trillion, all based on confidence that other people will pay for what you have.